Today we'll be like discussing on the topic measuring a nation's income. So here we'll be like looking into topics like what is GDP, which is gross domestic product, and how GDP is related to calculating the complete income and spending of for one particular country, and what are the components of GDP, and how you can correct GDP for inflation, where we'll be like discussing about real and nominal GDP, which we kind of like discussed in our previous session as well, and how GDP will affect, I mean, will help you to understand your society's well-being. I mean, if your country is doing good, means it's like, are they really? Is the country happy? We're gonna like look into these kind of aspects. Yeah, let's jump into the session. So first, I think we have discussed this already, but still we'll do a recap on what is microeconomics and macroeconomics. So in microeconomics, you'll be like studying about what happens in a household, how firms make decisions, and how they interact with one another in the markets, how the households and markets, I mean firms interact in the market. Whereas in macroeconomics, you'll be like studying an economy as a whole, where you'll be like studying about a country's income, inflation, GDP, uh, income and expenditure levels, and many more. Okay, so you can't just say, you can't segregate micro and macroeconomics completely different, because they're little related to each other. Okay, um, for example, you have Walmart. Its income and expenditure is kind of, uh, uh, it's uh, it's kind of little higher than few small countries. Okay, so I would say the GDP of Walmart is kind of higher than few countries. So yeah, so sometimes, but the study of Walmart, I mean, when you like decide what kind of products and supply and demand curve of Walmart, that belongs to microeconomics, whereas that small country's economic study will be belongs to macroeconomics. Okay, it depends on how it has been segregated. Okay, not on the level of complexity of numbers you deal with. It just depends on the segregation. Okay, so next, GDP is actually, it measures total income of each and every person in the country. Okay, it's not a like book definition, but that's what GDP does. Okay, it measures total expenditure of a economics output of goods and services. When I say total expenditure, it also the income. For example, I'm a person who's buying toys from a supermarket. Okay, so for me it's an expenditure. For us, for the shopkeeper, that's the income, right? So here, for every economy, the income will always equal to the expenditure. So one person's expenditure is another person's income, another person's income is another next person's expenditure. Okay. Okay, so you all should have remember this circular flow diagram. I think we have discussed it very, very long back. We discussed about factors of production, and we talked about, households and firms, how do they work, right? Households, they own the factors of production. I mean, they have the labor, but they buy and consume the goods and services which the firms produce, whereas the firms, they buy from the factors of production, and then they use the laborers to produce goods and services, and they sell it to the households. So that's how they're related to each other. you know you have markets of production where households provide labor, land, capital to the firms, and in turn they get income, because the firms are like paying wages and rents and profits, whereas in the market for goods and services, the households spend and buy goods and services, which is a revenue for the firms, right? Hope you all remember this. I mean, our GDP calculation is completely based on this. Okay, that's why like I'm showing you this. Okay, so the definition of GDP here is the market value of final goods and services provided within a country in a given period of time. Okay, so here you have to really carefully understand the keywords of this definition. Okay, first it says market value. Okay, market values are nothing but the value where all these goods and services are priced in the same unit. For example, in India, the market value is always measured in INR, whereas in US, it is in USD, dollars. In Australia, it is dollars, but it's AUD. The value of US dollars is completely different from US dollars, right? And it's different from Singapore dollars. Okay, so the denomination sounds the same, but it's completely different, right? So here, everything that the numbers are measured in the same unit. Okay, but here, if you're not measuring things like, the interest for the money that you have like invested in your company, or the work that you are doing, I mean, all this implicit cost, right? It is not measured here. Okay, next one is the final goods. So here we are like measuring only the final goods and services. For example, you are a company which makes threads out of cotton. Okay, so and you supply to a company, textile industry, which makes shirts. So in this case, so the threads which are manufactured out of cotton is not a final good, because it goes to another company where it will be processed more, and then the end product is a shirt. So here the value of producing the value of thread, the income, the manufacturing company which got from selling a thread will not be computed. Okay, you only take care of the final goods and services value here. Okay, here the goods intended for the end user, so intermediate goods which are used in the production of other goods are not included, because I'll tell you. For example, you spend 30 rupees in making a thread, and then 50 rupees in making a shirt. Okay, so company A spends 30 rupees, company B spends 50 rupees. But it should have like paid 30 rupees already to the previous company. So 30 plus 50 is 80. So the consumer might pay 100 rupees, so that it's 100 rupees. It's priced at 100 rupees, so that the the shirt making company makes 20 rupees profit. Okay, so you buy 100 rupees. I mean, the company gets 100 rupees. So that is like added to the GDP. So if 30 rupees which the company have already paid to thread making company, so if it is added, the value will be become 130 for the same shirt. Hope you are able to like understand why we are like calculating only the end products value. Okay, so that's why we are neglecting all the intermediate goods here. And next one is goods and services. So we only value goods and services, tangible goods and intangible services. Okay, it can be anything. So it can be a table and chair, or it can be your 5G network service. Yeah, it can be anything. So okay, it's about both goods and services. Next one is production. Okay, we are like taking care of only the products which are produced in the present, not the past. Usually, the GDP is calculated every quarter, so it's 4 times a year. So a quarter is 3 months. So this is accounts for only 3 months. Okay. Next one is within a country. Okay. So here the GDP measures the value of production which occurs within the country borders. Okay. For example, if you are buying raw materials from the different country, and then if you're making it, yes, that is fine. But if you're like buying a complete finished product, you will not be like taking that product into the GDP account. Okay, it will be in the export and import account. It will not be in the GDP account. I mean, yes, export and import will also be included in the GDP, but still not in the production. Okay, so here GDP measures the value of production that occurs within the country. So it can be manufactured either by that particular country citizen, or a foreigner. For example, we have HUL, Hindustan Unilever Limited, which produces very different kinds of brands in India. Since it is like manufactured in India, that the GDP of that particular products will be added into India's GDP. Whereas if we import HUL products from different country, that will not be added. Okay, even though a foreigner is coming and manufacture here, it will add GDP. It will get added to our GDP, even if you export that. Yes, we'll be looking into that in the later slide. Okay, I think we discussed this already. In a given period of time, it's usually a quarter. Okay, so now I think you'll be able to understand the whole definition of GDP, right? It's nothing but the market value of final goods and services produced within the country in a given period of time. Okay, hope you are able to understand it. Okay, next we'll look into the components. Okay, so there are like 4 components involved in it: C, I, G, and NX. C is nothing but your consumption, I is investment, G is government purchase, NX is net exports. Okay, sum of all these 4 things will give you a GDP. Okay, let's look into what is C, what is I, G, and NX. Okay, consumption is nothing but the total spending by a household on both goods and services. So, for example, if I buy a toy for my daughter, yes, it is accounted. If I buy a mobile phone for me, yes, it is accounted. If I buy a water bottle, yes, it is accounted. Okay, but if I'm gonna like spend on my housing cost, it will not be accounted. Okay, I mean, if I'm living in a rented flat, so the rent which I pay, yes, it will be accounted with housing cost because I'm enjoying the services. But if I own the flat and then if I'm gonna include that purchase price here, it will not be accounted because that comes in investment because I've invested in buying this property, right? So that will not be in the consumption rate. So here it's just like on goods and services which you use it on a day-to-day basis without investing too much of money in it. Okay, so that is consumption. Next one is investment. So here, this I is a total spending on goods which will be used in the future to make more goods. So, for example, if a factory is like investing in buying a new land or building a new factory or buying new machineries, all this will be investment. And also the inventories. So the inventories like they have created, for example, IBM makes uh, computers. So if IBM makes a computer and it gets added to the stock, it gets added to stock and it's be in the warehouse. So it will be like in the books of IBM or in the GDP, it will be like created in a way such that it's a set or an investment of IBM. So when the IBM sells the computer, it becomes a income. Okay, it becomes income. So inventories also is your investment. Hope you are able to like understand this because sometimes people have like tough time sorting this out. How you can have the finished products in the investment category? Yes, that's how it works. Okay. So here in the investment, when you like buy stocks and bonds, it is not called as investment. Whereas when you buy a house, that is investment. Okay. Next one is government purchases. So if a government is like spending on any goods or services at all levels, even from corporation level to the federal level, okay, at all levels when the government purchase on on different goods and services. For example, if they like kind of buy raw materials to lay down a new road, yes, that becomes a government purchase, right? But this completely excludes the transfer payments. For example, the pension schemes and any unemployment insurance, and the government was like giving some welfare funds for people who are below basic income level during this COVID-19. All these things will not be part of the government purchase because because the people who got this money will be like spending it, right? They'll be like going to the shops and they'll be like spending it. So that becomes their expenditure. Okay, so it will be accounted price. So the transfer payments are not included here. Okay, next one is net exports. So NX. So NX is nothing but exports minus imports. Okay, so here exports here represent the foreign spending on the economies, goods and services. Okay, so whatever that we have, like exported, and imports are nothing but you we consume, right? We consume imported products, we invest in them, and government also purchase the imports. Okay, so total export minus imports give you net exports. So that's why usually I think you should have heard it from a lot of people and from news, or like in a lot of forums saying that if you have more exports, your GDP will increase. It's obviously because this formula, because we have GDP, NX was part of it, and then NX is nothing but exports minus imports. So when if you have more exports, this number is going to be positive. But if you're going to have more imports, okay, this is going to be negative. NX is going to be negative, right? So which actually decrease your GDP of country. So to have a country's GDP more, you have to export more than and import less. Okay, so the components of all these GDPs, when you sum it up, you will get a Y, which is GDP. Okay, consumption plus investment plus government purchase plus net exports. Okay, okay. So we're just using a very old example of calculating GDP for US. Okay, so we have GDP. It's $14,000 billion. Consumption is $10,000 billion, and investment is one around $1.5 billion, $1,000 billion, and G we have like 2.9 billion. But the exports are in, I mean, like net exports are in negative because US is kind of importing more than exporting. Okay, so when you see the percentage of GDP, consumption was around 71%, investment is 10%, government purchase 20%, whereas this is 2% -2%. Okay, per capita. I mean, when you like do that, I mean, when you calculate GDP per capita, which means you divide this Y in terms of money with total number of population in your country, with total population in your country. So the per capita income of you know US people was around $46,299, which is pretty much high when compared to most of the countries. That too in 2009. Okay, so the conception was, for example, if a person, was kind of consuming $32,000, and then he was investing on $5,000, and then government purchases for like $9,900, and for every person, the government is like doing investment of $9,000, and the import is like -$1,000 net exports. Okay, so now we'll get into the concept of real versus nominal GDP. I guess you already know this, but still, yeah, we'll just like have a review on this. Inflation can distort a lot of economic variables like GDP. So GDP's value, affects is most of the time get affected by the inflation. Okay, so nominal GDP values output using current prices. It is not corrected for inflation. So we discussed this. Whereas like you'll be like calculating values out of, based on the prices, whereas in real GDP it values output based on the price of the previous years. You can consider any base year as your previous year. Okay, so real GDP is corrected for inflation, whereas nominal GDP is not corrected for inflation. Okay, so here you have an example of pizza and latte. Okay, in 2005, the price of a pizza is $10 and the quantity is 400, whereas for latte it's 2 rupees and the quantity manufactured is, I mean, current number of latte made is 10,000. Okay, and I have a table for 3 years. Just a minute, guys. Just be on hold for a while. Okay.